Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, a relief rally underway on Wall Street, with stocks set to extend gains as President Trump softens his trade rhetoric, specifically on China, and says he has no intentions of firing Federal Reserve Chair Jerome Powell. The president's comments easing investor concerns that sparked the so-called Sell America trade, where U.S. stocks, treasuries, and the dollar all sold off in tandem.
Plus, Tesla shares rallying this morning. CEO Elon Musk vowing to pull back significantly from his work with the U.S. government.
Starting next month, I'll be allocating far more of my time to Tesla. And now that the major work of establishing the Department of Government Efficiency is done.
Those comments from Musk come after one of the worst quarters for the company, with net income falling 71% in the first 3 months of the year. Despite today's rally, several analysts on Wall Street are slashing their price targets for the EV maker.
And Apple and Meta facing a combined nearly $800 million fine in the European Union for violating antitrust laws. The penalties imposed under the EU's Digital Markets Act come amid a warning of harsh retaliation from President Trump. Both Apple and Meta have responded critically to the fines, with Apple accusing the EU of discrimination and Meta saying the EU is handicapping American businesses. The companies have 60 days to comply with the decision or face further financial penalties.
A relief rally underway on Wall Street, with U.S. stocks looking to add to Tuesday's gains as President Trump floats substantial cuts to China tariffs and says he has no intention of firing Fed Chair Powell. But can the gains last? Joining us now to discuss is Keith Lerner, Chief Market Strategist and Co-CIO at Truist. Keith, good to see you here this morning. I mean, my goodness, if I had longer hair, it would just be blown back at this point, because there's quite a whipsaw of will they, won't they, that's present within the markets right now. And for investors, they're just trying to get a wrap around how quickly we've gone from the buy the dip mentality to the sell the rally mentality that some investment strategists have told us about. Where do you sit within the broader analysis right now?
Yeah, well, I think you summed it up really well, and always first great to be with you in Madison. You know, the way I think about it is this. You're right. I mean, basically where we're going to open today is close to where we were about a week ago. And the reason why we had sold off a week ago is because we were concerned about the Federal Reserve and then China. So basically we're selling the market on one thing and then we're moving the market back on the same news in reverse. Our view on a big picture perspective is, yes, you got a little bit of an oversold condition before this, right? You were down about 5 or 6% off those recent highs. Listen, the market probably can push a bit high. I think 5,500 on the S&P is the first level to look at, and then around 5,800. I think probably the upside is likely capped in our view around that 5,800, because I think in the backdrop, you still have uncertainty on this policy. You are likely facing an economy that will likely slow down. And it's hard to say that you should be at the same valuations you were coming into the year, knowing that there's still a high degree of uncertainty.
So, Keith, have we seen the lows of this sell-off? Are they behind us?
Oh, that's always a difficult question. You know, we don't know for sure, but I will say, at least on a short-term low, we had the characteristics that you tend to see around the low, that 4,800, 4,835 on the S&P. That was a 50% retracement of the bull trend. You had the VIX spike, you had some negative sentiment. So I think that's a pretty good, at least short to intermediate low. I think the question becomes later in the year, if you start to see the economy falter a bit, do we get retested or break below? But in the interim, I think really what you're basically in is in a choppy trading range, a wide one, albeit between that low that we just mentioned around 4,835 and the upside, maybe 5,500. And again, perhaps you squeeze a bit higher to that 5,800 level. But I think it's unlikely that you get much headway above there, which will be maybe a frustrating environment at times for investors.
Keith, it was becoming clear at the beginning of the earnings reports that were starting to come out this season that the theme or the mode might be uncertainty. And we've continued to hear that play out, because beyond 60 to 90 days for a lot of companies, they're saying the visibility is less clear or a bit murky at this point. So how does that play into the investment strategy right now, especially if you're looking across your portfolio and trying to figure out who's most exposed to tariffs, who is most exposed to any type of major change in the consumer mindset as well?
No, it's a great standpoint and point of view, I should say. And I mean, listen, we always live with uncertainty. Sometimes we don't just realize that, that what's tomorrow is. I mean, Warren Buffett once said, on September 10th, 2001, the world first felt very certain, but actually it was very uncertain. So the question we always have to try to grapple with is, are you being adequately compensated for that uncertainty? I guess at the lows, you were being better compensated. As we start to move up, it's a more mixed reward, risk-reward backdrop. So the way we're trying to do this is, even on a sector standpoint, we have utilities as more of a defensive play. We have our favorite growth area, which is communications, and we have our favorite cyclical area of financial. So as the market's bouncing back and forth, we don't want to try to call each turn. It's almost impossible. From an overall big picture perspective, we would say if we have that bounce above 5,500, we would likely pare back somewhat on the equity side. Again, not saying this is red light, green light, go to all cash, but we would lower our equity exposure somewhat on these bounces and really stay, slightly below risk or somewhat more neutral on an overall allocation. This isn't, to us, going to be a V-shaped recovery to the upside.
So, Keith, is there a Trump put after the market action we've seen this week?
Well, it goes back to the question you had before. I think that around that 4,800 level on the S&P, you can see people were searching for where this put level was, and I think we hit it. I think that was a level where there was more attention paid to the market volatility, and especially the 10-year, not just the stock market. I think there's a put on how far or how high Trump will feel comfortable with the 10-year Treasury yield as well. So yeah, I do think that at least saying that there's some focus. It does matter. Yeah. I think the level relative to where we came into the year is lower than most people expected, though.
And so with that in mind, are you kind of running through how the president is responding to the market, the whipsaw action that actually is what a lot of people are calling self-induced? Is he finally coming around to realizing that within that self-induced nature of some of the pullbacks that we've seen, that he's also responsible for any type of, or inserting any type of calm back into the markets?
I think part of what you just mentioned is true. I mean, he just met with some of the biggest retailers yesterday. I'd love to be, on the outside of that meeting listening in, because I'm sure, they were talking about shelves being empty in 3 months. So I think more than just the stock market, I don't think he wants to have headlines that says, hey, prices are going up, shelves are empty. I think that he is more sensitive, and also the polling numbers as well. So there's some sensitivity to it. Now, we also have to remember at the end of the day, as much as the White House can influence the day-to-day, and we're seeing that, at the end of the day, it's still about companies and profitability and making adjustments as well. And companies are still, there's still, as you mentioned earlier, we don't know what the next 3 to 6 months looks like. And we're seeing all this inventory being brought in ahead of time. One of the concerns we have is what happens if the demand isn't there 3 to 6 months from now, and they have to start, reducing the prices as well.
Keith, I want to end on recently you all downgraded U.S. equities, upgraded cash. If we're talking barbell strategies, do you like cash more than bonds in this environment as a hedge?
Well, maybe, on the margin, I would say yes, because I think it gives you some optionality, especially if we're going to continue to see this battle between fear and greed. To have a little bit of dry powder, is positive. One thing we actually upgraded for the first time in some time, there was investment grade bonds where you're getting about a 5 to 6% yield, and you're being better compensated today. So listen, I would say both, but on the margin, maybe a little bit more on the cash side.
Keith, thank you so much. Always great to chat.
Thank you.
Well, Treasury Secretary Scott Bessent speaking at the Institute of International Finance at 10 a.m. Eastern, expected to answer comments on the economy and trade. Joining us with what we can expect, Yahoo Finance Fed correspondent Jennifer Schomburger. Hey, Jennifer.
Good morning, Maddie. That's right. Treasury Secretary Scott Bessent set to speak here in Washington on the state of the global financial system in the midst of the IMF World Bank spring meetings, as both he and the president are seemingly smoothing rhetoric with China as they try to soothe tensions. Tuesday evening, the president said that he agreed with Secretary Bessent that the U.S. and China were essentially in a trade embargo and that tariffs on China will come down substantially but won't go to zero. His comments coming hours after Secretary Bessent told a private event on Tuesday that no one thinks the current status quo of tariffs of 145% on China and 125% on the U.S. is sustainable, and that he expects a de-escalation, according to people familiar with his remarks. Bessent stressed that the goal isn't to decouple from China, though he acknowledged negotiations with China will be a slog and hopes to have a comprehensive deal in the next 2 to 3 years. China responding this morning, signaling that the door is open for trade talks, though Beijing warning that they will not negotiate under continued threats from the White House. We will hear more from Secretary Bessent at 10 a.m. Back to you.
Jennifer, thanks so much. Now time for some of today's trending tickers. We've got some trending tickers we're watching this morning. Apple, Meta, Intel, and SAP here. First up, the EU hitting Apple and Meta with fines totaling up to $798 million for violating its tough new antitrust rules. While the penalties under the EU's new Digital Markets Act are lower than previous fines, the companies must comply within 60 days or face further charges here. We're actually looking at shares of both of these companies higher, at least pre-market, but of course there is pretty much an everything rally as of right now coming into the start of today's trade.
And of course that's going to lift these big tech names. But what's really interesting about this fine is it's actually a little bit lesser than the fines that we typically see coming out of the EU for these big tech firms. Is that a sign that the EU is trying to play ball with the Trump administration amid the ongoing tariff war, or is it something else? Of course, remains to be seen. The fine, some 700 million euros, obviously lower than the usual amount for these types of fines on these issues. But next up, let's get to another name we're watching. Intel set to announce plans to cut more than 20% of its staff this week. That's according to Bloomberg News reporting. The troubled chip maker is looking to make big changes under its new CEO. The company looking to get rid of its current bureaucracy by trimming management and focusing on an engineering-driven culture. That really stood out to me when taking a look at this announcement. It is set to come this week. And of course, this is one of the biggest moves made by the current CEO after the ousting of Pat Gelsinger. After some of the company's issues, you can see those shares up a little over 5.5% right now.
Yeah, and the company has essentially been looking at the totality of its business and trying to figure out where it can offer up certain parts of the business to, and you could see a lot of private equity, similar to what they already did with that 51% stake that was sold of its Altera programmable chip business to Silver Lake. You could see even more of that private equity interest start to flow in around Intel, and we'll see exactly what that does for the movement of shares, shareholder value. As of right now, pre-market, you're seeing that move higher by about 5%. But on the whole, if you're looking out to the past year, it's been a rough go of it for Intel, and now trying to figure out where they're going to continue to get some of perhaps the earmarked dollars that actually get put forward. Now it's trickier because it's administration over administration that they're trying to get some of those promises fulfilled for chip investment and manufacturing as well here.
Absolutely.
Finally here, German software company SAP beating Wall Street's expectations in its first quarter and maintaining its full-year guidance, sending shares higher. SAP, which is now Europe's largest company by market cap, overtaking Novo Nordisk last month, saying it will be able to navigate President Trump's changing tariff policies here. Shares of SAP up by about 9.7%. One of my former employers, proud enough to say, on this move to the upside for their overall value with Europe. And I think one of the larger things for SAP and how they've continued to insulate their business over time, regardless of administration, is making sure that they do have these strong portfolio of clients that they can sell further into. It's very much been an acquire to grow type of business over the years. We'll see how much of the dollars internally they start to put towards homegrown solutions as well here.
Yeah, and it's certainly a good read on some of the other names in the space. Obviously, we're seeing a lot of lift this morning off the back of a slew of positive catalysts for the market here, but certainly seeing a lift in some of the peers in this space, particularly when you look at the likes of Oracle, Microsoft, and potentially a signal to come for IBM as they are set to report this week as well.
That's right. You could scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's Trending Tickers page. Coming up on Morning Brief, we count you down to the opening bell on Wall Street. Plus, we bring you the bull and the bear case for Tesla following its results. And we dig into Boeing earnings as the company's cash burn improves. All that and more on Morning Brief.
Tesla shares rising today after CEO Elon Musk vows to refocus on the company, taking a step back from his role leading the Department of Government Efficiency under the Trump administration. He'll be involved just 1 or 2 days a week. This comes after the EV maker's first quarter profits plunged 71% from a year earlier. The automotive revenue down 20% year over year. Here's Musk on the earnings call.
the large slug of work necessary to get the Doge team in place and working in the government to get the financial house in order is mostly done. And I think starting probably in next month, May, my time allocation to Doge will drop significantly.
Joining us now, Dan Levy, Barclays Senior Autos Analyst. Dan, great to speak with you. I know you predicted that a good narrative could outweigh weak fundamentals on the stock, but you still have a hold rating on it, even though that's exactly what we're starting to see play out in the stock market action pre-market this morning. Where do you stand with Tesla after these results?
Yeah, thank you so much, Madison and Brad, for having me. Look, I think this is the challenge with a result like this, is that you're balancing on one side what was fundamentally quite a weak quarter, gross margins that, while a little better than anticipated, were still in the absolute one of the worst levels we've seen in a decade plus, a reduced volume outlook, weaker commentary on margins as far as tariff impact, et cetera. But on the other side, you're balancing it against a more engaged Elon Musk and a robotaxi opportunity that is overall, I would say, fairly intact. So we try to be balanced with those two. That's what keeps us equal weight, but we acknowledge, hey, this is net probably positive.
What's the likelihood that they deliver all of these things on time? Robotaxi, humanoid robots. You've also got better mass market vehicle, more perhaps price sensitive to the demand in the market right now. What's the reality of them actually achieving these in the timelines that they've set forth?
Well, Tesla's never been very good on hitting their timelines. And they've had some products out there that have been, always concepts, right? Think about how long we've had Roadster in the works. Semi has never really ramped heavily. All of these things, have been sort of in the works. But overall, they've had a good track record in aggregate on ramping on some of their new technologies. It's just the timelines have always been mixed at best.
I guess, Dan, just help me understand. You said something fascinating, that you're keeping yourselves equal weight, but you acknowledge that this is probably net positive. I can't imagine someone telling me they're net positive on a stock after some of the numbers that we have seen on this print. Walk me through, what is it about this print that makes those abysmal numbers easy to look through? What am I missing?
Well, I think this gets to the fundamental question of how do you evaluate stock between fundamentals and narrative, right? And the pendulum is constantly swinging back and forth. At some point, weak fundamentals should play a role. And, just to give you a sense, our EPS estimate for 2025 now is now roughly $1.68. This is into the year. Consensus was north of $3. We thought that this could be a growth year. And in fact, with the tariffs, with weaker top line, it's a challenge. But I think we all know that Tesla is not a stock that you pick your 1 or 2 year out EPS number and apply a regular multiple. This is much more about narrative. This is much more about excitement. It's a comp to Bitcoin, right? That Bitcoin is something we always say is the closest comp. And as far as the narrative goes, what we got last night was it held in okay. And that's why net on this result in the very immediate term, it's probably net positive.
As we're seeing some of, as well, the kind of net positive price targets that are out there from some of the largest bulls in Tesla, from what you were mentioning a moment ago, in even the thought process around how Tesla could even be in the same neighborhood as an investment, perhaps, I don't want to say thesis, but the investment mindset that would even permeate around Bitcoin, that would say that Tesla is only able to get back to some of those most bullish price targets if there is a purely risk-on narrative that re-enters into the market. And maybe that's the wrong evaluation, but I'd love to know your thought process around what Tesla needs in order to actually reach some of those targets that are starting to be set forth by the largest bulls out there on the street.
Yeah, it's a couple of things. And I think you raise a good point. Definitely a risk-on environment, an environment that's more engaging of speculative assets helps. This is what we saw with the stock rally late last year, where it was completely disconnected from fundamentals, and in fact, anything fundamentals deteriorated on the margins, right? So a risk-on environment certainly helps. Look, I think over time, these growth opportunities do need to be judged. So we have to see where we are in terms of, okay, are they actually scaling on robotaxi and autonomous? Is Optimus actually materializing into something that's helping them? These are the areas where we have to see how this all plays out over time, and maybe that can help. But I think it's that plus, as you mentioned, returning to more of a risk-on environment.
Dan, good to see you this morning. Thanks so much for helping us break down some of the earnings.
Thank you so much for having me.
Certainly. Tesla getting several price target cuts following weaker than expected first quarter results. Automotive revenue down 20% year over year, while total net income was down 71% from a year earlier. Here with us now, we've got Stephen Gengaro, who is the Stifel NextGen transport analyst. Good to have you here with us. You're bullish on Tesla, despite some of the warnings that we've heard from other analysts. How are you evaluating the company post-earnings and what we heard from Musk on the call?
Yeah, thanks. Good morning, and thanks for having me. So when we look at Tesla, and we've talked about this pretty often, is the near term is going to be bumpy, and we have seen the data. We actually have a group within Stifel that runs these really good surveys on favorability ratings, et cetera, and we've seen this sort of significant drop in net favorability rating towards Tesla, and that clearly was a headwind for sales in the quarter, along with some other things. I think people speak a little bit less about on social media, but the reality is they were rolling over production on their most important vehicle, the Model Y, throughout the quarter. So that had an impact as well. And the results effectively were weak, but I think they were expected to be weak. When we think about the company, we look past the short term and really look at the story that's developing around full self-driving and robotaxi, and that's a huge part of the value creation for the company over time.
And I'm curious whether or not that forward-looking story that you talk about is still intact, given some of the branding challenges. Investor Ross Gerber spoke about those challenges with Yahoo Finance yesterday. Take a listen.
Tesla is fundamentally a different story than where it was several years ago. I mean, Tesla was a massive growth story. And now Tesla is a very mature EV maker with a CEO who doesn't work there. People just don't want their products, even though they're the best products in the market. So I don't know how they solve this. So I think Tesla's best days are behind it at this point.
Stephen, with that in mind, can you put the genie back in the bottle when it comes to Tesla's branding problem?
I think you can. It's one of the things we talked about in a recent report was we kind of look back at things like the Bud Light I don't want to call it scandal, but the Bud Light issues that they faced, the issues with Nike and Colin Kaepernick, the issues with Target for a short period of time when they had the whole transgender bathroom discussion, and kind of these things are sort of these corporate positions which can impact the companies, they can impact sales for a short period of time. And I think that's why the news last night that sort of somewhat expected, but the fact that Elon has talked about taking a lot more time at Tesla and a lot less time maybe in the public eye as part of the government, I think was so well received. Now, the duration of sort of the impact of his involvement, clearly is hard to gauge, and how that kind of plays out from a sales perspective. In the world of, X and social media, we kind of, we hear the barbells on most issues, and a lot of what we hear, clearly on Tesla has been negative from the far left, and cars getting keys and vandalized, et cetera. But the reality is they still sold a lot of cars in the quarter. They mentioned on the call the order flow on the Y, and the new Model Y has been very good. So I think this sort of does dissipate over time, but it remains a short-term headwind for sales.
It's interesting because you typically had and just acknowledging that we still don't have the firm reporting on exactly who was behind a lot of the vandalism and everything that you were mentioning a moment ago. So just want to be clear on that. But all that taking place does have a longer term type of mind share kind of, it sucks up a lot of the attention in the room away from what the company is trying to do at the end of the day. And so how long does it take for Tesla to regain that or put that at the top of the list for potential car buyers? Oh yeah, at a time where buying a lot of vehicles right now is perhaps very expensive for many people out there who are just trying to evaluate, if they're going to be able to use a tax incentive, and they're not going to be able to, it sounds like, in the near future.
Yeah, but it's interesting. You obviously you have the macro, right, which is sort of the economy, the environment, the consumer, inflation, et cetera, interest rates, and then you have the maybe the micro on the company side. The reality is they have been affected, right, and we see it in the data. And one of the really intriguing things that we saw in some of the data that we have is that the willingness of Democrats versus Republicans to buy EVs is pretty significantly different. Part of it's geographic, right? Because the charging infrastructure is more on the coast, and range anxiety and charging is kind of a big part of buying an EV. But the other part of it is a bit political. And what we've seen actually pretty interesting over the last 6 months, maybe 4 to 6 months, is the Republicans' willingness to buy a Tesla and the favorability rating has risen sharply, and the Democrats has dropped significantly, right? So are there enough kind of Republicans buying Teslas that's going to offset that? Probably not. But I do think that, the impact of Elon's political involvement and the hatred we've seen online, et cetera, it will dissipate. Is it going to take a month? No. Is it going to take 2 years? That's probably not. So I think you'll start to see those buyers come back to the market.
Yeah.
I read something, I think yesterday, just about, Tesla sales in California were still extremely strong,
right,
in the month of March when the new Y came out, right? So I think it's overblown. It has an impact, but I think it's a bit overblown in the media.
It'll be interesting to see if the margin pressure continues then. Stephen, thank you so much. Really appreciate you making the time. We're going to have all your markets action ahead here on Yahoo Finance. Stick around.
That's the opening bell at the New York Stock Exchange and at the NASDAQ. You got Rex ringing the opening bell on the right side there. Go ahead, press that button, get yourself some funfetti as a reward. And you've got Elm ringing the opening bell at the NYSE. All right, those are our bell ringers today on this hump day. Taking a look at the Dow Jones Industrial Average. We are up right now by about 2% to start off today's trading activity. Take a look at this line chart here that I've got dialed up for you, and I'm going to put it up on a 3-day view because, oh yeah, this encapsulates everything that we've been watching over the course of this week so far. Big dive Monday. Rally back on Tuesday to try and eradicate the losses that took place Monday, and now adding on to some of the gains here as President Trump walking back some of his commentary around Fed Chair Jerome Powell, or at least the most harsh of what the street was trying to grapple with about whether or not the president did have any grounds to fire Fed Chair Jerome Powell here, and if that would come to fruition or not. It seems like we've moved off of that a little bit. Markets rallying right now. NASDAQ Composite, you're also seeing that move higher by about 3.6% to start the day here. And then additionally, the S&P 500, you're seeing that up by about 2.6% to start off today. It also is part of the trade narrative here as well. We're going to hear from Scott Bessent. We'll see exactly what he has to say at 10 o'clock. That gives us a little bit more of the details, perhaps, around where the administration is moving forward in discussions and negotiations on tariff policy as of this juncture. So markets breathing a sigh of relief at the start of today's trading activity. Let's take a look at some of the sector activity. As of right now, we are higher across the board here, led by technology. That's up by about 4% to start off today's trading activity. XLK, you've also got consumer discretionary catching a bid here on the day. That was also one of the leaders yesterday that I believe we saw at least through most of yesterday's trading session. You're seeing that be the same case here on the day. And then speaking of technology, let's dive into the NASDAQ 100 here. Tesla, they just reported earnings after the close on Tuesday here. The financials missed on a few of the major metrics here, but overall, it seems like there is a little bit more relief here within that trade that Tesla CEO Elon Musk is going to be spending more time back with Tesla instead of with Doge here. So reallocation of those priorities, that is playing into the investor sentiment on TSLA today and that trade. You're also taking a look at some of the other Mag 7 names here on your screen, all in positive territory as of right now. Apple up 3%, Amazon up 7%-ish, Google up 3% as well, Meta Platforms, NVIDIA, and Microsoft all moving higher by a few percentage points. And then just lastly, let's ride out with a look at the Dow Jones Industrial Average here. 30 components, we've got them dialed up here for you on the screen. It's caboose is being pulled right now by Verizon. That's pulling up the caboose. But Boeing Aviation, which we're going to talk about just a little bit more in today's show, that's up by about 7.8%. So stick around for that conversation. Maddie?
Thanks so much, Brad. It's time now for today's strategy session. A relief rally is underway on Wall Street with stocks extending gains. But what did the technical indicators spell out for what comes next? Joining us now, we've got Adam Turnquist. He is LPL Financial's Chief Technical Strategist. Adam, we love speaking to the technical bros when there's so much market volatility because you can give us an indication of where things are heading in times of so much uncertainty. Talk to me about whether or not you think, based on the technicals, that we've already surpassed the market bottom, or is there more pain to come?
Hey, good morning, Maddie. Happy to be on, especially with some green on the screen today. And when we look at the overall technical evidence, we use what we call the weight of the evidence. And we look at price action. And when you look at the S&P 500, it did come down, retest an important uptrend that goes all the way back to those COVID lows. So we can check the box there. Bulls stepped up at a very key important support level. We look at momentum. And we got historically oversold, 99th percentile type readings in some of the indicators we look at. The internals of the market, we call it washed out, meaning basically all of the breadth had been washed out and there's very little stocks above their key moving averages. So we check the box there. And then, of course, we look at overall sentiment. And I think it's easy to make the case we're at contrarian levels, not only from the investor standpoint, but from the business community, from just Americans, households as well. Pretty bearish sentiment being baked into equity. So the recipe there does suggest we have hit the capitulation point. Now, the problem is, where do we go from here? Just because you hit a capitulation point does not mean you immediately move higher. Is this latest rally just a relief rally off oversold levels or something more is the big question now.
Adam, I've been fascinated by continuing to look at the percentage of the market right now that is still continuing to trade below its 200-day moving average here. And I don't know if there's any analog that we can look back to really give us guidance as to how long in previous periods or pullbacks we've seen 75 to 80% of the markets be below a 200-day moving average for an extended period of time, and what comes next.
In terms of the percentage of stocks above their 200-day, we got to what we call, again, washed out levels. We had mid-teen readings. Now, when you look at the shape of other recoveries, if we are at a market low, the V-shaped recoveries, you get a snapback in terms of breadth expansion. We'll call it a breadth thrust, where a lot of stocks get back above those key moving averages. That's one thing missing right now, and it's not just the 200-day moving average. We look at the shorter term moving averages and really start there using the 20-day moving average. And it's been pretty underwhelming when you compare it to, for example, the last 5 bottoms that we've had in the market. We're well below levels that are associated with breadth readings on that 20-day moving average. So I do think this will play out as more of a bottoming process than a V-shaped recovery. If you think about those V-shaped recoveries as well, where you had that breadth snapping back and a lot of stocks getting above their key moving averages, they typically were overlapped with a Fed pivot. That was the case in 2020, 2018, and then even going back to 1998. And I don't think you can make the case, especially after hearing from Chair Powell last week, speaking at the University of Chicago. It doesn't sound like they're in any hurry to make any pivot moves.
And Adam, I've heard sources also tell me, just on a stock basis, that the biggest laggards that take you into a bear market can often be the ones that recover the most coming out of it. So obviously that brings us to tech. What are the technicals telling you about where tech might be heading?
That's exactly right. And this rally today in tech is certainly constructive. And tech has been an underperformer really since last summer, starting to break down throughout the first quarter here. Technical is not great within the tech sector, but it is very beaten up. I think the bear case there, pretty well known. We've seen some pretty important levels hold in some of the key tech names as well. But when you look at the composition of this latest move higher, we'll need to see tech participate, if not lead. When you think about the weighting, that's a 30% weight in the S&P 500. So it's hard to imagine a sustainable recovery without tech. And I think days like today are certainly constructive for looking at it as a more sustainable move higher.
Adam, at this juncture, it doesn't seem like there's a ton of short covering that would need to take place in order to drive this market higher. So what and who from our best analysis is driving the market and the bounces that we've seen even within this broader downtrend?
overwhelmingly, it has been retail buying hand over fist really throughout the first quarter, even in post-Liberation Day volatility. When you look at some of the U.S. equity positioning in retail, we're talking plus 2 standard deviation levels in terms of the assets under management that they're in terms of U.S. equity exposure. Who's selling to retail? Well, guess who? The hedge fund community side. That's been in the first quarter. They are underweight by historical standards. Maybe that suggests there's some short covering potential here or dry powder to put to work if we talk about a sustainable move here off these lows.
Really interesting to hear that retail might be behind the relief rally. I don't know how happy the hedge fund managers are going to be to hear that. And thank you so much for joining us. Appreciate it.
Thanks for having me.
Coming up, shares of Boeing moving higher after reporting earnings for the latest quarter. We're going to break down what's ahead for the plane maker next. We have breaking news. The Trump administration is considering a major rollback of tariffs on Chinese imports, in some cases cutting them by more than half. This is according to reports from the Wall Street Journal and according to people familiar with the matter. This comes in an effort to ease some of the pain that we have seen roaring across financial markets off the back of these tariff policies. You can see stocks hugely moving to the upside off of this news. You've got your S&P 500 up almost 3%, your tech-heavy NASDAQ up nearly 4% here. Now, we have no final decision yet on this from the White House, but sources say there are a few options on the table. One of them is a tiered system, 35% tariffs on non-strategic goods and up to 100% on items deemed critical to national security. Another White House official, again, telling the Wall Street Journal that we could see between 60 and 65% tariffs, well below the plus 100% tariffs that we have right now. The president saying on Tuesday that he is open to lowering these tariffs as well. That initially caused a bit of the market rally that we did see after the market open this morning here. Again, China signaling that they are open to talks, but we have not heard any news that Chinese PM Xi Jinping has called the White House to discuss these negotiations. But it'll be interesting to see whether or not we get more clarity on what that final number is going to look like when we hear from Treasury Secretary Scott Bessent. That's coming up at 10 a.m. Eastern.
Shares of Boeing rising after the aviation giant reported a narrower than expected loss for the first quarter as it expects to reach the maximum production of 737 MAX aircraft later this year. While these results do not include any impact of tariffs beyond March 31st, CEO Kelly Ortberg saying the company has the flexibility needed for the current macro environment. Joining us now to break down these results, we've got Tony Bancroft, Gabelli Funds portfolio manager in aerospace and defense here. Tony, good to see you here. So, one of the things that was really catching the street's attention here, it seems, around Boeing is them petitioning to be able to get production back to peak or ramp up production more fully around the 737 MAX line here. If that is the case, what would the pass-through look like for Boeing's financial performance, and how immediately would you expect to see that?
Yeah, it's great to be back. I'd say the 38 a month rate cap is probably the critical component to Boeing's cash flow performance going forward. They're just right now they're just subscale. They're not able to utilize the operating leverage that they have with that installed base of infrastructure, and until they really get back to near that 38 a month, they're gonna be struggling. I think over the next few months, hopefully we'll see some good news. Obviously, so far this week we're seeing good news, and from last week as far as this morning the earnings release and them talking about a steady rate increase in production. They're still confident of the 38 per month they can get by the end of the year, and then the wins on the F-47 in defense, and then just overall stabilization of the business is all good signs.
Tony, how good is this news? Is Boeing fully out of the woods in your view?
I think it's incremental. Obviously, this tariff issue is still going to be a headwind until there's some resolution. Obviously, Boeing exports 80% of its products internationally, and I think there's a lot of moving parts in there. Of course, countries that are potentially doing retaliatory tariffs like China. They have their own issues. They need these parts. 40% of their fleet is a Boeing aircraft. they're trying to make their own aircraft, the COMAC, which is essentially a Boeing a 737 minus, using all mostly U.S./Western highly engineered aircraft parts, including engines. So I think Boeing still we have to work through that, but in the near term, this is definitely positive incremental news, especially with the cash flow burn is not as bad as people expected.
How significant is Boeing selling parts of its business, or at least the part of its business that it recently identified that it would do just fine perhaps with doing away with, or at least having someone else own that asset? How much does that give them some breathing room financially and on a capital basis, and how long do they need to stretch that for until they are able to ramp production back up for some of the most embattled parts of its fleet production, and then secure more orders along the way?
Yeah, that's a good point, Brett. I think Boeing CEO Ortberg has been very direct about getting off of these sort of non-core businesses. Boeing's an aircraft maker, right? They build large commercial planes, and they have a defense business where they build fighter aircraft. As far as the Jepson digital pub business, it's a great business. I mean, I used every pilot in the fleet. Every pilot has to bring pubs with them, and obviously there's a digital version now. But it's a great recurring business, but it's not really core to their operations, and there's probably a better owner for it. I think maybe the space business, there's probably going to be some thought process going into that. Even though I know CEO Ortberg talked about getting more Starliner launches this year, I think in the long term, do they want to be competing with SpaceX in that business when it's probably not as core to them? So I think it's important that they get some cash in the balance sheet, pay down some debt, and then focus on their core operations, which is building essentially the 737. They've got to get that at rate.
Tony, we got just about a minute here. I would be remiss to not ask you about the roaring market rally that we are experiencing at this moment because of, in part, this Wall Street Journal exclusive reporting on the Trump administration considering slashing back those proposed tariffs on China. As you can see, your S&P up over 3%, your tech-heavy NASDAQ now up over 4%. I know you focus on aerospace and defense. Just how big of a deal is it for that sector specifically if we do, in fact, see a rollback to this degree that's proposed in this reporting?
Yeah, Matt, it's definitely a big deal, but I think sort of taking the next layer, aerospace and defense is somewhat specific here as far as, it's a secular growth industry. It's got Boeing itself has a 6,000 plane backlog, a decade-long backlog by both OEMs, and people are flying more. That's just the reality. And I think the bigger issue is these planes it's a razor blade business where these planes need to be serviced and maintained, and you need to get new planes. The efficiency improvements in newer planes should drop right to the bottom line of these airlines, and more of the world is flying. So I think in the long term, the world's going to need these planes, and tariff, no tariff, this is sort of a demand that's just unconstrained right now, and it's probably continue to be for quite a while.
Tony, thank you so much. Appreciate it. Let's get another check on the major averages off the back of reports that China tariffs could be cut in some cases by more than half. This reporting coming from the Wall Street Journal, speaking with White House officials on background who said to the Journal that the China tariffs were likely to come down to between roughly 60 and 65%. The administration also considering a tiered approach, 35% levies on goods up to 100% on things that are considered national security threats. The big news to me in this, the bill proposed phasing in those levies over the course of 5 years, a stark difference to the overnight tariff implementation that we saw on Trump's so-called Liberation Day. We're going to have all your markets action ahead. Stay tuned for more. You're watching Morning Brief.
Breaking news from the Wall Street Journal. The Trump administration is considering slashing its steep tariffs on Chinese imports, in some cases by more than half, in a bid to de-escalate tensions with Beijing that have roiled global trade and investment. Joining us for more, we've got Yahoo Finance's own Rick Newman. Rick, as we're taking a look at the markets here, another leg higher that we're continuing to watch play out here. What do you believe the discussions are playing out like in Washington, D.C. between Trump and his closest advisors to signal a move like this?
Well, the current tariff on most Chinese imports is 145%. If that sounds ridiculously high, it is. In fact, it's so high that there are really not many goods even moving between China and the United States at this point. I think many importers have said, no, we're not going to pay that tariff. We're going to wait and see what happens. So that is not showing up at stores just yet. And the reason for that is that importers saw the tariffs coming and they really stocked up on stuff. So inventories are pretty good right now. But think about what happens as people buy stuff, inventories come down, and everybody waits to buy new imports from China based on whether these tariffs are going to be there or not.
Yeah.
At some point, there just aren't going to be products on store shelves. And my guess is that at the White House, the Treasury Secretary Scott Bessent and other Trump aides are saying, well, we're basically seeing no trade, no stuff coming in from China because of these tariffs, which means we're going to have shortages by June or July or August, which, by the way, right around the back-to-school shopping season. That's what analysts have been telling me, where we're going to really see these problems. So Trump is finally realizing that 145% is too high. As far as we can tell, by the way, China hasn't made any concession. This is just Trump making a concession.
So, Rick, we've got about 30 seconds left, but how much can investors trust in the reality behind this reporting? Is this real?
I think it probably is real, but keep in mind that the story here is that Trump is willing to cut the tariff from 145%, perhaps cutting it in half. That's still a huge tariff, and that's still a huge tax hike from where we started at the beginning of this year. So don't get too euphoric.
Don't get too euphoric. Not stopping the NASDAQ from nearing 4% gains right now. Rick, thank you so much for making the time on this breaking news. Always appreciate you. That's going to do it for the morning brief this morning. You can join me in the next hour for more analysis on that breaking news on those China tariffs on Catalyst. And then Brad will be here with you for all of your personal finance needs on Wealth at 11. Stick around.